flocking to private credit as they look to diversify their portfolios. For more on the demand and themes to watch now, Fortress Investment Group co-CEO Drew McKnight joins us here on set. Drew, welcome back to Fast. Great to have you.
Thanks for having me.
Where are the pockets of opportunity for you now as this, this demand for it has sort of gone inning by inning by, I don't know where we are. You can answer that in terms of demand.
That's a good question. Look, I think the way people define private credit, I think, is evolving, and I think the private credit pie is growing. Initially, private credit really came about post-GFC, filling the void of the shadow banking system that folks talked about a lot. And that initially started primarily in LBOs and buyout financing. I think private credit, as a definition, has grown immensely. And I think when you define it more broadly and you start to capture consumer finance, mortgage finance, asset-based credit, the denominator is just a lot bigger than the way people have traditionally defined it. And so while I think we're cautious on some of the buyout financing, because I think that has gotten quite competitive, I think when you look at asset-based credit and some of the, frankly, larger asset classes, the growth there, I believe, is just getting started and is actually very early.
And to that end, I mean, you're pointing out to our producers that the disintermediation of regional banks in particular, I mean, they've got a lot of commercial real estate on their balance sheets, and that's an opportunity for you to step in. That's
right. And again, I think you've seen it. Really, it got exacerbated post the Silicon Valley Bank, Signature Bank, First Republic in 2023. It took a little while for that to digest. But I think when you look at banks, you look at their balance sheets, you look at the duration of their portfolios, where everything in real estate has extended duration just because of interest rates. And that has caused banks to pull back. You couple that with what they saw in 2023, which was a deposit flight and a run on the banks. And I think that caused all of them to reassess their liquidity and think about what they can allocate capital to. Asset-based credit, which I touched on, and is an area of growth, not just for us, but for a host of folks. We've done $7 billion of originations in asset-based credit since the fall of 2023. And we're really just scratching the surface. People talk about whether there's a bubble in private credit. You talk about the opportunity set. We believe it's like a $6 trillion opportunity set. So yes, it's growing, but the amount of capital that does need to move from the small and regional banking system into private credit is frankly immense. And so the formation of capital, I think, is important. I think the other thing to think about is, can you actually achieve the returns? And that's something that I think we're seeing. You talk about private wealth, and you think about traditionally a portfolio that was 60-40 stocks and bonds, and obviously the world's slowly evolving. But I think about my mom's portfolio and what would I be comfortable with her having. You look at what private credit has delivered over a cycle, over interest rate volatility, over stock market volatility, and you're achieving high single digits to low double digits with very low volatility. And I would much rather my mom have a portfolio of some of that mixed in with a stock and bond portfolio. And so I think ultimately the ability to achieve returns is what's most important. And that's where I think we feel, frankly, quite strongly about the opportunity set.
So on Friday, Jamie Dimon said there's going to be a crack in the bond market. I'm telling you it's going to happen. It's going to happen. I mean, he was pretty adamant about that. What does that mean for your world?
It's a great question. And I think, obviously, the markets are telling us globally that this is front and center. I think what we take some comfort in the asset-based credit world is you've got floating rate interest risk. You've got floors in your SOFR. So you've actually got your if interest rates collapse, you've got floors built in. If interest rates are higher, you float. And with the structures that we're seeing, even with the demand, we're running scenarios at loss curves at 2 and 3x what the global financial crisis is. So you're fairly conservative in terms of credit assessment. And so, frankly, from our perspective, we feel like it's actually a place to hide where you can earn those, high single digits, low double digit returns on a net basis in a somewhat insulated world versus the volatility in the stock market and the risk in the bond market.
So we know private equity has been slow. And one of the things that caused the slowdown is the IPO market being closed. But that's sort of starting to change, right? There's a number of high-profile deals. We've had a few. Do you think, is there enough of that to sort of get the wheels or the rolling again in the ecosystem?
We're hopeful. I do think it's early. I think the IPO markets are open. I think the real issue for private equity isn't that the IPO markets aren't open. It's the price that private equity wants to sell their companies isn't necessarily at the market clearing price. I think if you had Jamie Dimon, David Solomon in here, they would tell you the IPO markets are wide open if you come to market at the right price. I think the issue right now is a lot of private equity that was bought in 2020, 2021 was bought at high multiples with low interest rates. And I think the real issue is the price of liquidity or the price of the go public doesn't match what they're projecting for their returns.